Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. This is a big week for global markets, with the White House set to target a number of countries with reciprocal tariffs. It's likely to create more turmoil for investors, as we've seen in recent months. So how do investors set up their portfolios to weather the storm? And how do you look through the noise to understand risk and identify opportunities? After all, this may be the investing landscape for the duration of the Trump presidency. Of course, the information in this episode is general in nature. It doesn't take into account your individual circumstances. You should always do your own research and seek professional advice before making investment decisions. Matthew Tan is Senior Asset Allocation Specialist at LGT Crestone. Matthew, welcome to Fear and Greed.
Thank you very much for having me, Sean.
So 2 months in, let's start big picture. 2 months in, how would you characterize financial markets and even the economy under Donald Trump?
Yeah, I think there's been an aspect of financial markets sort of waking up or adjusting to the reality of what Trump is actually trying to achieve with this second administration. And the way I'd actually think of categorizing it, and I know people have been talking about recession risks and stagflation risks, I'd almost call this an uncertainty shock. So if you think back to say 9/11 as a recent historical example. Something crazy has come out of the blue. We're not sure what exactly is going to happen following it. Businesses and consumers are uncertain. And in that sort of environment, the natural reaction is to freeze up. And that's what we're seeing. Consumer sentiment is falling. Consumers are freezing up. Businesses are freezing up. And we're all just waiting for the chips to fall to see what the landscape is going forward. And that's the kind of lens to which we are thinking about, I guess, at least a short-term outlook for markets from here.
Okay. Do you think there is some underlying strategy plan in the Trump administration around tariffs and some of the decisions they're making?
I do believe there is one. I'm not sure whether I'd call it a genius master plan, but I will say that, while it seems very important to keep track of every little tariff announcement that comes out on any given day, investors who are too focused on this minutiae risk missing the forest for the trees. We actually think that Trump's overall fiscal strategy is what's driving his tariff strategy, not the other way around. And if you really want to get a handle on, what is happening, why it's happening, and what could happen, you should really start with that fiscal picture.
So explain the fiscal picture under Trump 2.0.
Ultimately, I think what Trump and Treasury Secretary Scott Bessent are trying to do is solve a giant fiscal puzzle. So Trump in the near term wants to pass his 2017 tax cut extension. That's a key election promise of his, and it will be a key pillar of his 2026 midterm election campaign for Congress. While Treasury Secretary Bessent, I think, has a longer-term goal in mind around stabilizing the U.S. debt and deficit. Now, there are 4 big levers that they're currently using to try to solve for this. One, they're negotiating with Congress on the actual details of that tax cut package, which currently calls for $2 trillion of fiscal savings to help partially fund that. 2, they can raise revenue through tariffs. 3, they can cut spending through the Department of Government Efficiency, or DOGE. And 4, they can reduce the Treasury's interest expense via lower rates, i.e. Fed cuts. And I think part of the seeming chaos that we've seen in recent weeks is they're basically pushing all of these buttons at once to kind of see what sticks and see what they can get through. And I think once we have a handle on that fiscal package, that 2017 tax cut package, you can sort of work backwards from there. And our view is that the uncertainty, the chaos, the headline risks may start to ease once he has that number that he can work towards.
Okay. So if we take that, so the DOGE he can manage, tariffs he can manage. He needs to get tax change through Congress. And are we talking corporate and income tax in this sense, Matthew?
I'd say that would be the aspiration, but currently what's probably practical that he can pass through Congress is just the personal income tax cuts. And that is the core of his election promise. And so I think he will negotiate away the corporate tax cuts in order to get those personal income tax cuts through.
Okay, and the fourth aspect is rates, which is independent through the Federal Reserve although political pressure, obviously. Does that make sense then to put those four aspects together? And yep, we're going to have a lot of turmoil in the next year or two, but if he can, cut spending, if he can lower income tax, if he can raise revenue via tariffs, and if interest rates can fall, can that all fit together and be sensible policy?
I think there's a chance that they could make this work. Now, they're skating on pretty thin ice because that R word that we're sort of dancing around, the recession risk, it's a threat and I think a negotiating tool that Trump and Bessent are currently using to try and force action from the Fed. So they're almost engaging in a giant game of economic chicken with Jay Powell at the moment. They're saying, we're not afraid of potentially causing a slowdown or a recession. You better get out of the way. In reality, neither the Fed nor Trump can afford an actual recession to occur because obviously in a recession, you get a deep fall in economic activity. It worsens the budget deficit significantly through those automatic stabilizers and the fall in tax revenue. So neither side wants a recession to occur. And what they're trying to do is dance around that risk while, like you said, balancing those four levers around Doge, around tariffs, and around potential Fed cuts to try and get there.
High risk. Stay with me, Matthew. In a moment, I want to come back and ask what this means for investors. My guest this morning is Matthew Tan from LGT Crestone. We've talked about the potential strategy behind what's going on in the US. Whether that is a strategy or not, whether it works or not, what about investors? How should they be thinking about what's going on geopolitically and, of course, locally around elections and all sorts of things in terms of interest rates and all that here? How should investors be playing it?
That's an excellent question. So there's a few things I think investors can do. So firstly, in terms of the short term, what we call a tactical time frame, which is called it 6 to 12 months, I think investors should really focus on what actually matters, which is the underlying macro, and think through what are the most likely scenarios and kind of position for that. So from our perspective, two key views, some of which are quite out of consensus, are we think that US fiscal policy is going to be contractionary relative to expectations relative to the rest of the world. And that feeds into that whole fiscal strategy, fiscal puzzle that Trump and Bessent are trying to solve for. And two, we also have a very high conviction view that tariffs are ultimately disinflationary. And because of that, we believe on a sort of 6-month basis, inflation, while it may appear scary, is actually not going to be an underlying problem for the United States. And therefore, there is not much of a hurdle for the Fed to cut if activity worsens from here. So if we have that framework in mind, on a 6 to 12 month basis, we are actually quite constructive on equity markets from here. I think in 6 to 12 months, equity markets will be higher than they are today. The road there may be bumpy. So if you want to be short term, you might try and think about trading and going a bit underweight equities over the next few weeks and wait for tariff announcements, etc. But having a 6 to 12 month mind frame, we're happy to sort of ride through this incoming storm and just stay constructively positioned on equities.
So just before we get into the medium to longer term, disinflationary, why do you think tariffs are disinflationary?
Yeah, so there's a few reasons why. The first is, and I think everyone agrees on this, tariffs are ultimately a tax on the consumer. Normally the analysis stops there, but we think if it's a tax, then like any other tax, if the government raises tax rates, it is sucking money out of the private side of the economy. By definition, that is contractionary, and almost by definition, that is disinflationary. In addition, as we're seeing today, the uncertainty around trade policy that tariffs brings damages business and consumer sentiment. And following from that, it also weakens business and consumer activity. So if you have less activity, again, people freeze up, they don't spend as much anymore. There's also, by definition, contractionary and disinflationary. So that's the economic theory behind it. I have two proof cases for you, and this data is publicly available from the US Statistics Agency. But if you look at what US inflation did in the aftermath of the 1930 Smoot-Hawley tariffs, which, keep in mind, that was the global trade war that everyone is worried about, where people were putting tariffs on everybody else. you actually saw significant deflation because the economic damage from those global tariffs more than overwhelmed the price increase from the tariffs. And the second quick example I'll give you, the Nixon tariffs in 1971, which is the other example people are worried about at the moment. They were put on in August of that year, and they lasted for 4 months before the economic damage from the tariffs was so great that basically all of the US's trading partners had to come together and give Nixon what he wanted, which was US dollar depreciation.
Probably in the long term is actually what Trump wants, is US dollar depreciation. We're out of time, but very quickly, for investors, the medium to long term. So the 6 to 12 months might be a rough ride, maybe trading opportunities. Medium to long term, Matthew.
Yep. So medium to long term, we think we're in a multipolar world. It's not Cold War 2.0, so it's not the US versus China, because there is the EU, there is Russia, there is India, various other powers. What that means, we think there's going to be more volatility. There will be a bit more dispersion between different countries, different sectors of the economy. And there may be more inflation as well compared to the post-GFC sort of experience. But importantly, and we like to stress this a lot, is that there will be a lot of growth in this new world. Companies and governments are going to be spending trillions of dollars to compete across AI, across defense, across high-tech innovation areas. And you tend to see a lot of productivity and a lot of innovation come out of areas of geopolitical competition like this. So what we're focusing on for our clients is building really robust, diversified portfolios that can weather short-term volatility like we're seeing now, but also leverage themselves to the profitable growth opportunities that we see over the next 5, 10, 15 years.
Matthew, thank you for talking to Fear and Greed.
No worries. Thanks very much, Sean.
That was Matthew Tan, Senior Asset Allocation Specialist at LGT Crestone. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.